This is just a short video to pick up and clarify, hopefully, the distinction between M&M, weighted average cost of capital, and what I'm going to call the sort of traditional weighted average cost of capital. So this is an example taken from Chapter 7, Test Your Understanding, and this was one of the requirements that we would have looked at. This was Section D, and it required you to calculate the weighted average cost of capital. And in the lecture last night, I used the traditional weighted average cost of capital, which effectively involved us calculating this figure of 15%, and I said let's leave it there. However, the issue was raised, the question was raised about the M&M version. And I didn't want to go into it too much last night, but now that you've had a chance to think about it, let's now explore that with the calculation using M&M. As you can see, I've worked that out already underneath. So this is the calculation, weighted average cost of capital, using the M&M weighted average cost of capital formula, slotting in the 15%, which is the cost of equity of the ungeared company, and working this out. Remember, this one was excluding tax. Okay, so the tax figure here becomes 0, and the whole of this part of calculation therefore becomes 0. It becomes 15 times 1 minus 0, which equals 15, which, as you can see, will give you the same answer here as here. Okay, now it's exactly the same if we look at the second example. Now the second example included tax, and the second example, this was the weighted average cost of capital figure that we worked out using, if you like, the traditional method. 13.6 was the answer, and this is the answer using the Modigliani and Miller method. Cost of equity ungeared. This time you can see we have tax, and therefore it gives exactly the same answer. Okay, now I didn't want to confuse it last night by talking about, you know, this. The question went through the answer, and I wanted to go through it using the traditional weighted average cost of capital, but of course what we could have done is use Modigliani and Miller. And what I hope this proves is that they're both the same given the same circumstances. What will determine the best one for you will be in the exam. Okay, and as you saw also last night, the objective test questions will say using Modigliani and Miller's weighted average cost of capital or their 63 version, and if it doesn't, we'll be using the more traditional weighted average cost of capital. Okay, I hope that resolves that. I hope that hasn't further complicated it, but I just wanted you to have the same answer that we had in the back of the notes so that it wouldn't confuse you for later. But please, these should give the same answer, and the only thing that, as to which one should use, it should be clear from the question.